Which bonds would you consider investing in? Do you know that in bond market the bonds can be classified into 21 types? Whoa, that's a lot. But before that, hey, this is Priyanshi and I welcome you all to our knowledge series by Smest Discover, where you can get smart about investing. You will be surprised to see the variety of bonds you have as an option to invest. Bonds are classified by different characteristics. Number 1, by the type of issuer. The first classification of bonds in this category are corporate bonds. Corporate bonds are issued by private and public companies to raise funds from investors. They usually have a fixed tenure and offer a predetermined interest rate. Second comes the government securities. Also known as G-Secs, government securities are issued by Reserve Bank of India on behalf of the government, and the funds raised from these are used to finance national development activities. G-Secs are the safest and risk-free as they are sovereign guaranteed. The next step in line are state development loans. State development loans or SDLs are debt instruments issued by the state government in India to raise funds for their state development projects. These securities usually pay a higher coupon than G-Secs. The number 4 in the list are state guaranteed bonds. State guaranteed bonds are issued by public sector undertakings, financial institutions, or other entities that are guaranteed by the state governments. These bonds are often issued by entities that are not directly backed by the government but have a public purpose, such as power, infrastructure projects, etc., to raise funds at a lower cost. The next are municipal bonds. Municipal bonds are issued by state or local governments or their agencies to finance public infrastructure projects such as schools, highways, water treatment facilities, and more. These bonds are backed by the issuing municipality or by the revenue that will be generated by the project being financed. The last in this category are treasury bills. T-bills are short-term debt securities issued by the RBI on behalf of the Government of India to raise funds for its short-term financial needs. T-bills are issued for a term of 91, 182 or 364 days and are sold through auctions to individuals, banks, financial institutions and other entities. The other classification of bonds is based on its maturity. Let's jump into it. Number 1 are the money market bonds. Money market bonds are issued by corporations and governments to raise funds for the short-term financial needs and typically have a maturity of less than 1 year and are considered to be relatively safe investments. Number 2 are the capital market bonds. Capital market bonds are issued by the companies or governments to raise long-term funds from investors. These bonds typically have maturities ranging from 5 to 30 years. And third are the perpetual bonds. Perpetual bonds, also known as PERPs, have no maturity date. The issuer continues to pay interest indefinitely until they decide to call them. Another way by which the bonds are classified is by coupon payments. Number 1 are the plain vanilla bonds. Simple of all, plain vanilla bonds are traditional bonds that pay a fixed interest rate on the face value and have a fixed maturity date. The next up are floating rate bonds. The interest rate of floating rate bonds are adjusted periodically with a benchmark rate which is published by the RBI. Currently, the benchmark used is the repo rate. The next up, zero coupon bonds, also known as deep discount bonds. They do not pay interest payments like traditional bonds. Instead, they are issued at a discount and mature at their face value, with the difference between the purchase price and face value representing the investor's return. For example, a bond's face value is 1000 rupees and has a 1 year maturity. It has been traded for rupees 950. When it matures after a year, the investor will receive rupees 1000 along with rupees 50 as capital gain. The fourth type are market-linked debentures. The market-linked debenture is linked to the performance of an underlying benchmark. Typically, it is the 10-year G-Sec and the coupon of the MLD varies based on the performance of the underlying benchmark. Another important type is the inflation-linked bond, also known as Inflation-Indexed National Savings Securities (IINSS). These bonds are issued by the government and are indexed to inflation so that principal and interest rates rise and fall with the rate of inflation. Next up is the classification of bonds on the basis of options. Here we go. The number one are the callable bonds. Callable bonds are the bonds that can be called back, or in other words, redeemed by the issuer before the maturity date. The second type are the puttable bonds. Puttable bonds are the bonds that allow bondholders to sell the bond back to the issuer before maturity. And the third type are the convertible bonds. Convertible bonds allow the bondholder an option to convert their bonds into an equity at a specific conversion rate and time. This bond provides investors with the opportunity to earn a fixed interest rate like traditional bonds, while also providing an option to convert the bond into equity if the stock price of the issuer increases. The next classification is on the basis of tax implications. Number one, taxable bonds. As the name says, taxable, the interest income and capital gain on these type of bonds are subject to income tax depending on the investor's tax slab. Number two, tax-free bonds. Tax-free bonds are issued by a government entity and the interest income is exempted from taxes. Number three, capital gain or tax-saving bonds. Tax-saving bonds allows investors to claim a tax deduction on the amount invested in these bonds. These bonds are exempted from tax under Section 54 EC of the Income Tax Act 1961, and these bonds are also known as 54 EC bonds. And lastly, masala bonds. Masala bonds are bonds issued outside India where Indian entities raise money from the overseas market in rupees. Both public and private organizations can issue these bonds and offer higher rate of interest with no currency risk. I hope this video gave you an insight to the types of bonds available. Visit smest.in and take the next step towards investing wisely. Stay tuned for more exciting lessons coming your way. But before signing off, always remember, investments in debt securities are subject to market risks. Read all the offer related documents carefully. For any queries on this module, please leave a comment below. See you in the next video.